Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
So if I can sell the November option at a higher price than I can buy the December option, I might be able to make money on a convergence of volatility. That is to say that either the November volatility falls to meet the December volatility, or the December volatility rises to meet the November volatility. And so when that happens, the idea of sort of netting out the Vegas goes a little bit out the window, because there's two different volatilities and they can move independent of each other. And that's a shift in the volatility skew, or the volatility term structure. And that can be an excellent opportunity when you discover it in a potential time spread candidate. Okay, so those were our long calendars. Let's take a look at short calendars. Okay, so once again, here's where I sell the option that has more time until expiration, and I buy the shorter term option. Again, they're both calls, both puts, and they're the same strike price, same currency, obviously. Now here, this is just the opposite. We've got time working against us, but we hope to profit from a big move in the underlying. And we'd like to try and get a similar volatility set up where we benefit from buying a lower implied volatility and selling a higher implied volatility. So in this example, I'm going to use the Canadian dollar. The symbol for this is CDD. Now, I'm going to show you the volatility chart in a second, and what you'll notice is that the implied volatility has been pretty level lately in this example. But historical volatility has been kind of rising a little bit, which makes me think that, you know, maybe I might be able to get long gamma, that is to get long realized volatility and profit from a big move if CDD starts moving more, you know. Now there's a question here that says, from Keith, is this the same as reverse calendar? You know, I believe that I have heard some people refer to this as a reverse calendar, but I would never call it a reverse calendar personally, just from my background, you know, on the trading floor where, hey, you know, I mean, if you're buying a calendar, I was the guy as a market maker who was selling you a calendar. You know, so I don't really look at any trades as reverse, but I mean, it is the opposite of a long calendar.
Dan, you and I would call it long or short a calendar, and that's about it, correct?
Yeah, that's exactly. I would call it either a long calendar or a short calendar. So, you know, stay away from terms like that because, you know, they can lead to biases. You know, they can lead to biases in your head where, oh, yeah, you know, I can only buy a calendar, you know. Okay, so here's the price chart, and you can kind of look, you know, from April to, well, I don't know, looks like about the end of May, we're kind of in a trend lower. There was a little hiccup around May, I don't know, the middle of May, but there was kind of a downtrend. Then there was an uptrend going up through the middle of July, then a downtrend. But now look here, we've kind of seen us trading in a channel, but it's kind of a wide channel, really. You know, I mean, there's been a little bit of volatility, and unlike what we saw before, where there were sort of bigger candles with the euro in the past, and they've gotten shorter recently, I don't know if you can make that case looking at this. I would say that the daily range is probably held pretty constant, and one could argue that there's a fair amount of volatility going on here. Now, here's how we quantify that, by looking at a volatility chart. as you can see, the implied volatility, that is basically the relative price of options when you kind of hold everything else constant. Option prices in terms of volatility have been pretty level since July here in the Canadian dollar. And the historical volatility, that again is the measure of the size of the fluctuations in this currency, you know, they were kind of bouncing around between, 13 and 11 for a bit, but they've kind of had an uptick recently, and they're moving towards the top of that range. And when you trade channels, one way of doing that is to look for breakouts. And so here, I can make a case for saying, you know, even though implied volatility is maybe a little higher than historical volatility right now, it has been flat. And if we get a breakout, you know, and it manifests itself into a trend, or if volatility just kind of keeps bouncing around and maybe gets a little bit more extreme, this could be an excellent candidate for a short calendar. So I would do that by buying the short-term November 106 call at 225 and selling the longer-term December 106 call at 305. So now here, because I'm selling the longer-term option, I'm getting a credit. And now for those of you who are income-generating traders, you know, you do iron condors and butterflies and all that business, calendars can be kind of funny because when you buy them and you're paying a debit, it's an income trade, and when you sell them and you get a credit, it's not. It's a volatility trade. So here we're getting a credit, and what we're looking for here is movement. And we can kind of look at, again, a fairly lousy illustration of what your risk is. Your absolute risk is measured by a P&L diagram here. Kind of gives us just a little bit of a swatch of our volatility. And it tells us, hey, I know if I stick pretty close to the shared strike price here, I'm going to get creamed because I have time decay working against me. But if I get a pretty good move in either direction, great. Then I'm going to profit. You know, this is kind of shaped a little bit like a bent-up straddle P&L diagram. And it's a similar concept, except for a couple of things. One is the comparative risk and reward might be a little bit better in some ways and worse in other ways. It might be better to trade a short calendar than to buy a straddle because of this curvature that you're seeing on these lines here. Your break-evens, while you can't really pinpoint exactly what they are closer together than they would be if you bought a straddle. So that's a benefit. But the trade-off comes that, you know, with a straddle, I mean, you'd like to see the underlying whatever it is go to zero or move to infinity, you know, to use sort of academic theoretical terms. Or you want to see a big move. But here, you can only make so much. There's a ceiling. Now, we need to kind of quantify this because as traders, we always have to have a plan. You know, we can't just kind of wing it and say, well, you know, I don't know, I think we're going to move. I'm going to sell a time spread because I know that the P&L diagram kind of looks a little like this. You know, that really doesn't work. You need to kind of quantify it by looking at the Greeks and really do a pretty solid analysis. Now, I know that because the Canadian dollar here is sitting pretty close to the strike price of 106, that I'm going to be pretty delta neutral. But I also know that if it moves, I'm going to benefit from gamma. And I'm noticing here that the gamma here for the calendar spread in this sort of straw color, it says negative, but it's actually positive, which means that as CDD moves higher or lower, I benefit because my delta changes in my favor. As we move higher, I get longer deltas, and I profit at an increasing rate. As we move lower, I get shorter deltas, and I profit at an increasing rate. That's a great thing to have going on for me.
Thank you for participating in this week's session. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.